great way to never buy a business is to tie yourself to just one bank. So the traditional independent searcher model is to build your team. Banker, lawyer, Q of E. But the problem with aligning yourself with one bank at the beginning of your search is that each bank has a different credit box. A credit box is the type of loan or the criteria for each bank for making a loan. And there are lots of different credit boxes. And one thing you want to watch out for, and we see this all the time, is bankers will talk about their bank's credit box like it's the credit box. They'll say, all banks want this. And really, that's not true. It's just something that their bank looks for. And a great example would be collateral. Different banks have different collateral requirements. The SBA's SOP has their requirement is zero, but different banks have different criteria. So you might hear someone say, you need to have $1 million of assets if you want to buy a $4 million business. When that's not true. There are banks that will do that if you don't have any. Or you might hear a banker say, you can't use investors to make 100% of your down payment. And most banks won't allow investors to make 100% of the down payment, but some will. And that's the beauty of the SBA guidelines, is that they give banks a lot of discretion so you can find lots of different lenders. And what lender might work for one business isn't going to work for another. So you might find yourself where your banker says, no, this deal isn't going to work, when really it's a completely viable deal. It's just not viable with their bank. That's why adding an SBA loan advisor is a much better way to go than adding a banker to your deal team. And of course, we're talking our own book here. Of course, we're telling you you should work with us, but we do think it opens up a much higher probability of you being able to get your deal done. So click the link in our bio if you need help getting your deal funded.